What's up, you guys? Welcome back to the Options Income Strategies channel here. I've got a very interesting video for you here today on how you can make monthly income selling options. Okay, now if you're completely new to options trading, I would recommend that you check out my video on how to trade options for beginners. And once you go through that, I would recommend that you come back here. But in case you do know options a little bit, I want to give a quick review on what call and put options are, and then I'll teach you how you can sell call and puts on a monthly basis and collect the premium as an income. Okay, so really quick, call options are bullish bets on a stock where you have the right but not an obligation to buy 100 shares of a stock at the strike price, with a bet that the stock price will be at least at the strike price or above by the expiration date. Okay, so say you have a stock that's trading at $30 on July 6th, and you buy a call option with a $30 strike price for a $5 premium and with an expiration date of August 7th, then you're betting that the stock will be at least $30 or above. Now, since you're paying a $5 premium to buy this particular call option, your option will break even at $35 and you'll start making a profit only if it goes above $35. Okay, and for every dollar that it is above $35, you will make a $100 profit. At every dollar below $35, you will make a loss of $100, and the loss will be capped at the $500 that you put in to buy this call option. Okay. Conversely, on a put option, it's the same as a call option, except you're betting that the price will actually go down. So the same example as before, where you were buying a call for a strike of $30. If you buy a put for a strike price of $30, now it breaks even at $25 by August 7th. And at every dollar below $25, you will make a $100 profit. Okay? And the maximum profit from a put option is if the stock price goes to zero, which it'll never do anyway. But the maximum profit is capped at $2,500, with your maximum loss is $500 if the price of the stock stays at $30 or above. Okay. Now, one advantage with call options is that there's actually no limit on the upside, because the call option can go as high as possible. So you're in no way capped on a call option. Now, having said that, if you noticed on how call and put options work, there are essentially five possible scenarios five scenarios in which a stock price can behave from an options perspective. Okay, so if you're buying a call option, the price could go up a little from the current price up to the break-even price. It could go up a lot where it's past the break-even price and you start making a profit. The price could stay the same, it could go down a little bit, or it could crash completely. And in all these five scenarios, the only time that you do make a profit is actually if the price goes above the break-even price on a call option. Okay, same thing for a put option. You only make money when the price goes down a lot below the break-even price. And in four of these other scenarios, you actually will lose on the put option. Okay, and it's for this very reason that selling options provides you an 80% chance of profitability and is a much better way to trade options than just buying calls or put options. Okay, now having said that, how do you actually make monthly income by selling calls or put options? Now, the first strategy is called covered calls. Okay, covered calls have the same concept as naked calls. Naked calls are where you're selling calls, but the advantage of a covered call is that you actually already own 100 shares of that stock, which can be used as collateral. Okay, now you want to sell calls at a higher strike price at which you're willing to sell your shares. And if the stock does go above that strike price, then you will be assigned to sell those shares at that strike price and you can lock in that profit. Now, if the stock doesn't go all the way up to the strike price and it stays below, then you get to keep the premium that you collected by selling that option. Okay, so let's say you own 100 shares of a stock that's currently trading at $35, and then you sell a call option with the strike price of $40 with a $2 premium, and you collect $200 for selling that option. Now, let's say a month down the line, if the stock price does go up to more than $40 or above, you'll be assigned to sell the shares at $40, and you would have collected a $500 profit for selling your 100 shares. Now add that to the $200 you collected in premium. Now you actually made $700. Okay. Now if it never goes up to $40 and if it stays below that, What that means is the options essentially expire worthless and you get to keep the full $200 premium. Okay, let's see a quick example here. So I'm taking Facebook as an example here. Let's say you um, let's say you just bought $100 of the stock at the current price. Okay, and you want to say that 1 month down the line, which is August 7th, the price will not go above $250. So you sell the call with the strike price of $250 and you collect a $565 premium for selling that option. By the way, if you have not seen this website before, this is called optionsprofitcalculator.com. I'll put a link to it in the description, but it's a great tool that you can use to analyze how options are going to behave between now and expiration before you even place any trade, okay? Essentially, now you sold the $250 strike price expiring on August 7th for a $565 premium, okay? Now, by August 7th, if Facebook doesn't go up to $250, you will keep the full $565 premium. If it does go above $250, you will be assigned to sell your shares at $250 and you'll get to keep the premium keep the profit of $250 minus $233.46 plus the $565 premium that you collected, and that would be a net profit of $2,219. Okay, now if it never goes up to 250, even if it goes up only to $249, for example, this option would expire worthless and you would still keep your full $565 premium. Okay, so those are covered calls. Now, the next strategy on how you can make money by selling puts is what is called cash secured puts. Okay, now it has a similar concept as covered calls, where in a covered call you need to own 100 shares of that stock to be able to sell that call and use those 100 shares as collateral. Except when you're selling puts, you don't need to hold 100 shares of the stock, but you do need to hold enough cash to be able to buy back the stock at the put strike price in case you do get assigned the shares. Okay, so what you want to do you want to sell puts at a lower strike price at which you're willing to buy 100 shares of the stock in case you do get assigned. Okay, if in case the price stays above that strike price, you get to keep the premium because now the put would expire worthless. So as an example, if a stock is trading at $50, but your analysis shows that the company's fair value would be $40 and you're only willing to pay $40 to own these shares, then you keep selling the $40 strike put option on a monthly basis, and until that stock drops all the way to $40, you will get to keep the full premium. And if it does drop below $40, then you would get assigned the shares and you can automatically buy 100 shares of the stock at $40. Okay, so what this essentially means is the cash collateral that you need to have in hand would be 40 times 100, which is $4,000 per put option that you decide to sell. Okay, let's see an example of that. So let's look at Facebook again. So it's trading at $233 as we saw before. So let's say 1 month down the line, you're willing to bet that Facebook will not drop below $210. Okay? So what that essentially means is that you collected a $418 premium for selling this put option, and at every price of Facebook about $210, this put option would essentially expire worthless and you would keep the full $418 premium. But if it does drop below $210, then you'll be assigned to buy 100 shares of Facebook at $210, meaning that you have to put in $21,000 to buy Facebook. Now, if you don't have that kind of cash ready to be able to buy 100 shares of Facebook, then first of all, you can't even sell put options because your brokerage will not allow you to sell put options without having that kind of cash as collateral, okay? But if you do own 100 shares, then this would be a great way for you to collect premium as the price drops and be able to buy back 100 shares and lower your cost basis while the stock is falling, okay? So that's all I wanted to share with you guys for today. This is a great strategy that you can use to keep making monthly income, depending on whether you already own 100 shares of a stock or if you have the cash set aside in your account to be able to use as collateral for selling the put options. Okay. Before you place the trades, make sure you do your research. Make sure you use the website to understand how much premium you're getting and what's the likelihood of this going through. I would personally recommend that you choose very far out of the money calls or puts to sell, because that will make it more likely for those options to expire worthless, and that way you get to keep the full premium. Okay. So thanks again, you guys. I hope you enjoyed it. I hope you learned something. If you have any questions, feel free to leave them below, and I'd be happy to help you out. Okay. If you liked it, please smash the like button and subscribe and hit the notification bell. And until next time, bye.